let's get started with our next round, our next session here. I want to introduce another friend and partner, Angela Smith, who's a good economic development friend and colleague in the region. She is currently the Assistant Regional Director with the SUNY Canton SBDC at Clinton Community College.
Good job.
Did I get that right? Woo! She is also a certified business advisor. She's helped over 700 plus businesses in the region. And I often say Angela is my role model for shameless promotion of the value that you and your organization can provide. And they do provide a lot of value at SBDC. She's a business owner herself, and she has also just recently been appointed by the governor to the North Country Regional Economic Development Council. So welcome.
Thank you. Many, many kind words. We have a really tight schedule, so I'm going to try and, as much as possible, stick to my script today. Come on, PowerPoint. Don't fail me now.
Angela, my stuff at the end is not as important. You're more important, so be more.
Okay, thank you. I appreciate it. Happy National Small Business Week. It's SBA week. So yesterday I was in Albany with SBA people. We were giving excellence awards to deserving businesses in the North Country. So it's always a pleasure to be a part of celebrating small business, which shapes our economic landscape. It makes our place so special to live in. Thank you for introducing me, so I don't have to say my full title and where I'm located. So SBDC at Clinton Community College are the key words to remember. We have a great presentation for you today. We're extremely lucky to be joined by Mr. Forrest Edwards. He's a senior accountant with Alexander Edwards and Company, a CPA firm in I'm going to say Lake Placid, Plattsburgh. With the 28th season barely behind him, he agreed to be here. So thank you so much, Forrest, for sharing your time with us. He will be the second half of this presentation, Preparing to Sell a Business, where we're going to talk about tax considerations when preparing to sell a business. Just a few words about the SBDC for those of you who are not familiar with our organization. We are a non-for-profit educational organization. There's actually 23 centers now in New York State. We just opened a new center in the Bronx this week. Over 1,000 centers nationwide. And we work with both new and existing businesses. A lot of people think we're just for startups. We are not. About 30% of our business is working with existing businesses where it's expanding, transitioning your to in different capacities. Our core services include one-on-one confidential business counseling. About 80% of our time is spent working one-on-one with the business owners. We also do training seminars like the one today. And we have 4 full-time librarians down in Albany, so if you're looking for market research data to beef up a business plan, to gain a better understanding of your industry, we can also pull some data for you guys, demographic data, industry data. We pay for certain publication. We'll talk about industry multipliers later on today when we're looking at evaluating a business. These are parts of the services that SBDC can offer for you. So we are providers of information so that our clients can be in a position to make really good decisions for themselves. All right, so today we're talking about the importance of planning ahead when selling a business so that you can maximize the value. We also want to remind everybody that selling a business is a complex transaction that's going to have financial, legal, and tax implications. And of course, we want you to know that there are resources available for you, such as the SBDC and CPAs such as Alexander Edwards and Company, and how we can help you as you're looking to prepare to sell your business. I forgot to mention, there are evaluation worksheets. If you need to sneak out early, please take a moment to fill this out. This really helps us understand how we can improve workshops or plan future workshops. So there might not be quite enough for the entire room, but if you take a moment, if you have to sneak out, I really appreciate your feedback. That's what keeps us working harder and improving our services. All right, so the baby boomers are retiring, right? And that's creating a huge opportunity in the marketplace. It's estimated that there's about 70 million baby boomers, and they're retiring at a rate of 10,000 per day. The baby boomer generation has had and will continue to have significant impact on the economy, but today specifically we're interested in how that's impacting business transition. Again, Danny made mention that numbers in our region are estimated to be somewhere between 10,000 to 16,000 businesses transitioning. Nationwide, the number is about 12 million. 1 in 6 private sector employee is going to be affected by a transition of a business from one owner to the next. BizBuySell is an online platform that sells, obviously, businesses online, but they also track a lot of great data. So since 2013, we're really starting to see an increase now in the number of businesses coming on the marketplace for sale. And I truly believe that we're only at the beginning of this curve, that it's going to accelerate even more, because baby boomers are waiting until their 70s to retire. So some of the former estimates were that this curve was going to start earlier, but there's been a slight delay, so we're starting to really see it start to happen now. The good news is that small businesses are selling. It's not just multi-million-dollar businesses. The median sales price, according to BizBuySell, they have 50,000 businesses listed and over 2 million visitors on their platform a month. So these are some of kind of the median numbers. So asking price at around $260, agreed upon price for sale around $239, so that's pretty encouraging. It's right in line with some of our business, small to medium business here that might be transitioning in the region. So the private sale of any business, regardless of its size, has to follow certain steps. People often think just because it's small that we can skip some steps, but I would really advise against that. The other reason to really look at kind of the different steps involved in selling a business is that it takes time to sell a business, right? A lot of people come to us like, oh, I'm ready to sell. I'd like to be retired in the next 3, 4, 5, 6 months. Well, chances are you don't get to dictate the timeline unless maybe you found a buyer already, but there's a number of things that have to happen. And I think we heard from our panel, securing funding is a huge piece of it. Very few sellers are lucky enough to get a buyer with cash, all cash, right? We'd all love to see that scenario happen, but the reality is we're probably going to need to work with a lender. And lender, it's not like getting a mortgage for your house. There's more steps, a little bit more due diligence that has to happen. So, there's a number of steps to consider, including the first one, which could take anywhere from 3 to 5 years just to prepare to sell your business. And we're going to delve into that in just a moment. Today, we're going to look primarily at the first 3 steps because we're really talking about preparing to sell a business. And I'm sure in the fall we can plan other workshops that deal maybe a little bit more in depth with due diligence and looking at some of the legal documents. So when a business owner wants to leave their business, they really have 3 options, right? They can sell the business, transfer it to a family member, or close and liquidate. There's no right or wrong answer. It's whatever feels good to the business owner and whatever the business owner wants to do. But with a little bit of advanced planning, even if you're just done with the business and would love nothing more to walk away, you might be able to make a little bit of money by trying to sell your business. If indeed it is sellable, because not all businesses are. A little bit of a reality check. We touched upon this, but baby boomers are really not well prepared for retirement. Nationally, the numbers say that less than 15% of business owners have a plan, despite the fact that almost 80% say that they're relying on the sale of their business to retire. So I'd like to say that you're among the 15% really smart people because you're here in this room thinking about this topic. So already have a leg up on potential other business owners that might be looking to put the for sale sign up soon. Planning is important because it's going to be a buyer's market. There's going to be a lot of competition. And the numbers are also indicating that less than 20% of businesses that are ever listed for sale will sell. And the reality is, again, is your business sellable? Because 6 out of 10 businesses never really make money. They break even or they actually lose money. So one of the questions is, do you have a business to sell, or are you primarily just looking at liquidating assets? So some of the benefits of planning ahead, right, will help you understand how you will be taxed on that sale, right? If you go ahead, sell your business, and find out, whoa, I'm getting hit with a massive tax bill, there's no do-over. You need to understand ahead of time what's going to happen. So this is one of the key drivers of preparing, of planning ahead, and that's why we have Forrest here with us today as well, because the tax implications, there's different ways of looking how to structure a sale, but there could be some very serious tax bills, which hopefully we can learn a little bit and reduce that with some planning. We want to make sure that you get top dollar for your business, so again, planning ahead of time can help you achieve that. And finding the right buyer also might take time, so allow yourself enough time to find the right buyer. So one of the first steps when looking to exit your business is get a business valuation. You can come to the SBDC, you can go see your CPA, you can probably even do it yourself. There's lots of tools out there, but you want to understand what the realistic range of value that you might be able to list this business for. And it's also going to force you to think about, are the assets of the business worth more than the business itself? For example, if a gym has equipment to the tune of $80,000 and after business valuation it's really only worth $50,000, right, as a sellable price, maybe you're better off discontinuing the gym and just selling the equipment. Real estate, there's special considerations for that. So again, sometimes real estate is worth more and the business can't necessarily support it. So you're better off separating them. Maybe you can also keep the real estate and generate rental revenue for yourself. So that's another part of your plan, and that will have tax implications. So things to think about. Bottom line is whenever we do a business valuation, it's really only worth what someone's willing to pay, right? So you're going to have to come to an agreement with someone on a price that they're willing to pay for the business. Even though you got the best valuation and someone tells you it's worth X amount, if it's sitting in the market with no taker, you may need to revise that number. It's okay to list. If you get a range of valuation, list your price at the higher end of the market for negotiation purposes. But we want to put a realistic list price because if you're too high, savvy buyers will take one look and they're not even going to bother contacting you to learn more about your business. That's why it's important to have a realistic price point as you're going in. So how can the SBDC help you with valuation? So we use some, we'll take a look at tax returns and we'll also look at profit and loss statements for the last 3 to 5 years in your business. We'll identify, right, sales, profit, EBITDA, and the big one for smaller business is seller's discretionary earnings, which we'll dig into in a moment. But every business owner kind of has some owner perks in the business, right? So we back that out to understand what a new buyer, what are the true expenses of the business for a new buyer. Things like your personal car is not necessarily going to be an expense on his line item. So that is really identify the true cash flow potential of the business. What we then do is contact our research network and ask for industry multipliers, right, that come from this business reference guide. And this business reference guide has like pretty much any business you can think of. Ice cream shop to garage door car salespeople. So, and they factored in all these numbers based on risk, transferability of clients once a new owner takes over. So there's a whole bunch of data. Businesses that have sold over the last 10 years to look at those types of numbers to come up with the industry multiplier. So the SBDC will take a look at your financials, use a published industry multiplier to help you assess a range of value for your business. We don't get into things like intellectual property or, not too much real estate, because that's also something that you can talk about with your real estate agent and or banker to really understand cap rates and different things like that. What does the industry multipliers look like? So for example, if I'm a restaurant, I would get a document back. It's usually 2-3 pages, but I'm interested in this top section here. So for example, it would tell me that multipliers I can use would be 30 to 35% of annual sales plus inventory. So that would be a way to come up with a range of value for the business. If I'm looking at EBITDA, so earnings before interest, tax, depreciation, and amortization, and on my data, on my documents is showing that I'm at 220,000, then you could use 2 to 3 times EBITDA, which would be north or south of the 550,000 would give you a range of value, potentially of what your business could fetch based on the numbers. So what what drives value in a business? It's really, this is not an exhaustive list, but these are the main things that drive value, especially from a buyer perspective, right? So if you want to convince someone to pay you good money for your business, most important thing you can do is clean up your books, right? You want someone else to be able to understand how your business operates. You want to also increase profitability, so money to your bottom line, because that's often where the multipliers are going to be applied. And a business with no profit is really worthless except for its break of value, right? The asset, the equipment, whatever dusty inventory you can get pennies on the dollar for probably. It's really important to talk to an accountant because, again, they can help you structure the sale, but they can also help you understand what portions should go to goodwill versus furniture, fixture, other things in the business. And this might seem like easy, logical things to do, but you want to make a first good impression. So spring clean that business inside and out. Make it look really attractive because people, first thing they do, they're going to look you up online, maybe even zoom in with Google Map Earth or something and take a look at that business, and you want it to be attractive to a buyer, make a first good impression. It's really also important, and we heard about it with our panel, how they're transitioning the business, right? So the existing owner's teaching the potential new owner. So that's a way to build, right, the management team so that you can successfully transfer the business. Because if you don't do that, and the business is really dependent on you, and you walk away, probably the new owner might not be able to make a go of it. And it makes your business less interesting because a savvy buyer will realize these people are the business. They haven't done the work necessary to beef up their employee skills or get some of their processes written down on paper. So it's really important to clean up the books because to buyers, and again lenders, most businesses will have to go through a bank to have a successful transition. Banks are going to look and buyers are going to look at the tax returns, right? The actual numbers that you're reporting. And oftentimes a business will prepare, end-of-year annual statements to minimize taxes. We're looking for all of our legal deduction, and that's legal. But when you're switching hats, right, from operating a business to selling a business, those 2 to 3 years, you want to take the time to prepare and start showing more money on your bottom line. When you hide sales, right, that cash sale that doesn't make it, that's not reported. When you're paying for things off the books. When you're inflating some of the business expenses with like personal cars, personal cell phone expenses. These are all things that inadvertently you're devaluing your business. So looking at different kinds of adjustments to cash flow, so things you can do over the next 2-3 years, take a look at your owner's compensation. Is it in line with the industry? Is there a way where maybe you eliminate that, put more money through the bottom line, and do member draws for yourself instead of having it as an expense item? What personal expenses are you putting through your business, right? So again, we talked about car, cell phone. There's all kinds of creative things that I've seen over the years people will put through the business. There's also sometimes non-controllable things, right, that happen. I need a new roof and it has to be addressed. So what we'll do when we're looking at the business valuation piece, if it's a one-time extraordinary expense, that's not an ongoing thing, we'll add it back in, to remove that from, let's say, year 2 of the 3-year average that we're going to look at. But it's really not the time to start making major investments in like brand new equipment, redoing your website. These are things that potentially the new owner is going to want to do himself. So you want to do things that add value to the business, but not over-invest where maybe now it's going to cost someone even more to get into your business. So this here's a really great example of how cleaning books can really impact your bottom line, put more money in your pocket. So would you rather have $22,800 savings from 1 year income tax, or get an extra $148,000 for your business when you sell it? So in this example, right, owner A, they both earn the same amount of money, but one of them removes personal expenses. So owner A doesn't remove personal expenses, so of course his net profit is less. So he's going to pay about $22,000 less in income tax that year. Owner B knows that if he removes and cleans up his books, he's potentially going to end up ahead of the curve. And here's why. So yes, he has a bit more money that he's got to pay taxes on, but when he goes to sell his business, he has a higher cash flow multiple. So if both businesses use a multiple of 4, the difference is actually $148,000. So a lot of people are so scared of putting money to their bottom line, but you are probably going to get that money back when you look at your industry multipliers. And that's why getting a business valuation done early on will help you to understand what are some of the multipliers in your specific industry that are going to be used. If it's a multiplier of 1 or 2, we can kind of maybe do the calculation and see how much of your books you want to clean up. But bottom line, the multipliers could range. I've seen, the garage door industry uses a multiplier of 9. So you can clearly see that if you're trying to save $5,000 times 9 multiplier, you're going to more than get that back into your pocket, even though you're paying taxes. So the key to selling a business is also understanding the buyer's point of view. And to a buyer, it's all about future cash flow, right? Because once you leave the business, they're asking themselves, am I going to be able to still get these same types of returns? And it's all about risk. If I put X amount of money into a business, am I again going to get a return on my investment, or am I better off putting it in the stock market or buying bonds or other things? It's really an investment when we're looking at selling a business. So now that you have a little bit more of an understanding of what drives value in a business, and also potentially know what range, what value your business is worth, take a minute to really think about what you want, right? Because that's really what matters at the end of the day. What's your timeline to retirement? Like, we've met with some people and they're like, you know what, in 2 years I'd like to be retired. Great. What needs to happen in those 2 years in order to meet your goal, right? I was working with some business owners, started last year on a project, and the business owners could not wait to get out of the business. It's a restaurant business, so first of all, you want to sell right before summer, because a new buyer, that's when they'll make their money and they don't have to carry over lots of dead costs until the summer season. But in the business owner's emergency to sell, they forgot to file taxes for the last 2 years. So now we've been held up for 2 months waiting for the business owner to file taxes. So because the SBA loan is held up, they're not going to touch that business until all the liabilities are off that business. So again, as a business owner, think about the things that you might be doing that you'll have to also. It's not all on the buyer to prepare. There's a lot of things that the seller can do, including making sure that all your legalese are filed away and that you're ready and able to sell that business. One of the things I always like to point out, so do you know, so your business might be listed for $1 million, but do you know how much money will be left in your pocket after you've paid taxes and all the other liabilities? That's really what we need to get to when we're talking about selling a business. It's not that list price, because you're not getting that $1 million in your pocket. So what else, what is left? And again, work, there is no substitute for working, it's cut off. No substitute for working with a great accountant or CPA, because there are the people who can really help you make an informed decision. You're probably going to need to assemble a team around you, right? So you're really good at running your business day in and day out, but how many of you have expertise in selling a business, right? Do you even have time to sell the business yourself, right? Maybe it's worth hiring a broker and paying a fee, because again, they might be able to protect a little bit of your identity or the identity of the business. They can vet potential buyers for you so that you avoid people that are potentially just kind of in the mood to look at businesses for fun. So there's a lot of different things that you can do. Some people you'll have to spend money on, right? And some services are free of charge. So SBDC can be part of that team. Center for Businesses in Transition with the matchmaking services. That's an incredible advantage that we have now. SBDC can't do matchmaking, but I'm happy to refer you to the Center for Businesses in Transition if I think that it's a good fit for what you're trying to do. So now that we've talked about the value, you're ready to sell, so you've got to find someone that wants to buy this. And as we noticed with the panel, most of the buyers they had somehow had a tie to the community, or they knew each other. So before you go ahead and hire a broker and list this publicly, take a moment to think about who do you already know, who might already be interacting with your business that might be a good fit, right? So existing employees potentially are good buyers, customers, even a competitor, because maybe for them they're not going to incur a lot of additional expenses by acquiring the business, but they might get access to your book of business. There is a company from Vermont that's going around buying North Country businesses because for him it increases his territory and it's a really good investment. I'm not telling you what kind of business he's buying. It's not a restaurant, it's not lodging, unfortunately. So when it comes time to listing the business, right, in the North Country, some of the brokers won't touch businesses that are listed for less than $75,000 to $150,000. So if you're a really small business, sometimes we're a little bit limited with the options. But again, with the Center for Businesses in Transition, I think that's a fantastic resource. Talk to your chambers of commerce, because other business owners might be looking to, or know people that are looking to buy a business. Your trade association. So if you're part of the lodging or restaurant industry, it might be worth paying a little bit to get back in membership with your trade association, because they might have listings that reach, could be New England Association or even further to kind of market your business. And of course, BizBuySell, there's a lot of online platforms, but SBDC works pretty closely with BizBuySell. They come to a lot of our conferences, and they've been a really great partner in terms of educating SBDC staff. And they actually don't take a commission. It's a flat fee to list your business on the website with BizBuySell. So these are all some good options if you're trying to market the business to a certain extent yourself. In order to sell the business, you're going to have to create marketing materials. I have an article here. I have a few more examples of a really detailed selling memo, if you will, what information should be included in there. But at a minimum, you want really good pictures, right? People are visual. We're talking about online listings. Make sure you catch people's eyes. What's the history of the business? Who's your customer? You want to share little tidbits about the financials without giving away all of the financial information. And of course, you as the seller have to come up with the price. It is your responsibility to throw out the first price. So again, if it's based on a business valuation, hopefully it's more realistic price. One of the questions that a lot of people are really concerned about is, how do I qualify a potential buyer, right? One of the major reasons that businesses, a deal falls through, it's because a seller enters into a transaction with a buyer who's unable to secure financing. So I did put in green, unfortunately, the financial piece, because that's really kind of some of the things we want to get down to. And it's hard to talk about money, but if someone shows interest in your business, there's some questions you can ask. And you should be prepared ahead of time to ask these questions, such as, how much money do you have to invest? Do you need to sell assets, right, to access the capital? Because if I have 2 or 3 buyers, and 2 of them have to sell their homes in order to access capital, and one doesn't, then maybe right there we have a front runner in terms of who we might want to talk to first. You can talk to them simultaneously if you don't have a contract, but there's ways to qualify buyers. You also want to understand if they need to secure bank financing, are they bankable? What's their credit score? You might not be able to run directly a credit score on that, but you can certainly ask the question. And if your timeline is 2 years to sell the business, we'll find out what's their timeline, right? So if they're living in Florida, so do they need to wait till the kid graduates college till they move up here? Like, what are their goals in terms of becoming business owners themselves? And just a quick word on legal documents. I'm hoping we can do a workshop this fall where we bring in an attorney to talk about these. Even your selling memo, you have to be careful how you structure that and how you present the numbers, because that's a document now that's public, right? So if you inflate numbers and make exaggerated claims, it could come back to bite you. Confidentiality agreement, so that is something that if you have an interested buyer, the seller will present that to a buyer, and that's actually part of your vetting process if you want to move to the next step. Hey buyer, are you willing to sign a non-disclosure or confidentiality agreement? It's a few different names for it. SBDC has samples of all of these documents if you want to look at them. But you do want to work with an attorney to make sure that these documents are enforceable in New York State. Why do we sign contracts? Because if a problem arises, you need to be able to enforce it in court. So you need to make sure that you're working with a good attorney as well. SBDC can help in a number of different ways, whether it's loan packaging, assisting with financial analysis, professional referrals, even if it's a good photographer or which brokers in the area are maybe more small business friendly. These are all things that we can help with. We have to provide 3 referrals because we have to remain neutral, but we work with both buyers and sellers. We will have separate advisors because, again, when we work with a client, we advocate for that client. So I couldn't work with both the buyer and seller. Who do I represent? Much like when you hire an attorney or an accountant, you want to use your own so that you have representation. A couple of things that the SBDC does not do. We are not a substitute for accountants or other professionals. We don't give out tax or legal advice, but we can provide information. We will not make decisions for you like, yes, you should sell this business, or no, you shouldn't. But again, through having a conversation, hopefully we will have some good feedback so that you're in a position to make that decision for yourself. Again, a great resource because this is a very detailed topic, selling your business. On BizBuySell, you can actually download this book. It's 150 pages. It'll walk you through checklists and all kinds of things to consider when you're selling your business, free of charge. If you're an SBDC client, BizBuySell also gives us 20% off listing. Just by being an SBDC client, we have special codes we can enter in, and they have all kinds of good data as well on their website for you to look at. So without any further ado, enough about me. Let's hear from Forrest Edwards on tax considerations. Is his slide ready?
Just keep going.
Keep going? Okay. Perfect. Thank you.
Well, thank you for having me. I'm really glad that we saved all the finance and the fun accounting stuff for the end of the workshop. And everyone's got their second cup of coffee, and we can just get started. Just to do a quick poll to get started, by raising hands, how many people here own a business? Good, good, good. How many people are here today to learn more about preparing for a business transition? How many of you have questions? All right. Well, my hope today is to be able to provide some answers to some of the questions you guys may have. My name is Forrest Edwards. I'm a third-generation accountant, and I'm here on behalf of our firm, Alexander Edwards & Company. We're a small firm located in Plattsburgh, New York. Our roots began in 1920 in the North Country, and we're coming up on our 100th year of providing sound advice to clients. Our current staff of 8 has collectively over 100 years' experience in business valuations, succession planning, and taxation of sales of closely held businesses. Then we get started about talking about 3 main areas of tax considerations in transitioning your small business. Those areas would be the sales structure or making a deal, seller financing and how it can be a very valuable tool to you as a business owner, and the estate and gift tax implications for those looking to know more about what would happen if they died while owning the business, or the best way to give their business to their relative. I like to look at the structure of the sale as a roadmap to your tax destination. We're going to look a little bit closer at the following 3 facets of the sales structure. Initial tax planning, which we've heard a bit about. Looking how you're currently organized and what's your best option for a sale. We're also going to look at if the sale is a sale of stock or a sale of assets. 2 very different outcomes for 2 very different transactions. And finally, we'll look at the allocation of assets in the sale and how it can be optimized for the seller. Initial tax planning should be occurring in a minimum of 1 to 5 years prior to the transition of your small business. Initial tax planning could be setting up the most beneficial vehicle to make your transition easier and save you money on taxes. Each of the 5 business structures listed has its positives and its negatives. Some of the reasons why you selected a business structure type when you first started originally grew the business and may not benefit you for the sale of your business. There's some things that can be done as easily as filing a simple form and making an election with the IRS to be treated as an S corporation instead of a traditional C corporation can be used to save you a good amount of money if strategic plans are implemented in a business sale and owner finance transaction. Seeing that each one of your guys' businesses is different, and it varies from each other. I'll have to look at each case individually to see if it's the right fit for your future. Here's where you started with the actual sale. What are you selling when you say you're selling your business? What are the assets of your business? There's two different types, a stock sale or an asset sale. A stock sale, the seller gives the buyer shares of the business. The buyer assumes control of all of the assets, liabilities, and equity. Yes, I said liabilities. This is where the stock sale can get tricky for the potential of unknown claims or sales tax liabilities, and those things can sometimes scare away buyers. However, if you can pull off a stock sale and sell just the stock of your business, you're going to be in a highly favored tax situation, only having to pay tax on the capital gains from the stock, which has a favorable long-term rate of anywhere from 0, 15, or 20, depending on your taxable income. Conversely, in an asset sale, the seller gives the buyer the assets, or sells the buyer the assets. The buyer assumes ownership of the assets of the corporation, thus owning the company by virtue of owning all the assets that made up the business and gave it value in its first place. This type of sale will attract the buyers as they can benefit from years of valuable depreciation and amortization expenses on the physical and intangible assets that they're going to be putting in service when purchasing your business. In this type of transaction, the seller pays tax on the gain from the sale of the assets at their adjusted basis. Fancy word. The adjusted basis takes into account all the valuable depreciation which you took advantage of throughout the years of using these assets, and it becomes subject to recapture rules. So when you're selling your equipment and you fully depreciate it, the kind IRS will come in when you go and sell it and claw back some of that depreciation they allowed you to take over the years. The funny thing about it is, whether you took the depreciation or not, so you failed to take depreciation, the IRS goes by the allowed or allowable, and they will claw back depreciation whether or not you took it or not. So you may ask me, how can this effect be minimized? The effect can be minimized by allocating varying portions of the sales price to different classes of assets, which each have their own flavor, let's say, of income upon sale. First off, let's talk assets. The best definition I could find in any dictionary is property owned by a person, company, regarded as having value and available to meet debts, commitments, or legacies. Assets can vary in liquidity and can be physical assets you can touch, or also intangible assets where their value is derived from control or ownership of the business. Think of the time it took you to build your current client list or to develop a trademark or patent. Think of how valuable it may be to your competition to have you not in the market anymore. These scenarios all have intangible value and can have a portion of the purchase price allocated to them. One piece of advice that we would throw out there is that if you do have a covenant not to compete, we suggest having it separate from the sales contract. Reason being is that allocations of sales price to covenant to compete or other intangible items exceeding 15% to a maximum of 35% could be challenged by the IRS, and a separate legal document would make it more difficult to challenge those items. Also, we suggest the covenant not to exceed 5 years in time or more than 50 miles from the place of business. This chart here represents the varying assets in which a purchase price can be allocated and how they would affect the buyer and the seller. As you can see, cash, marketable investments, and inventory sold at book value do not have any built-in gain. Another item to talk about when you're selling, if you have inventory, you're going to want to get cash up front for that. Inventory is an item that you could easily sell, or they could easily sell and produce the cash. So you never want to finance inventory for a buyer. The asset category priority levels 1 through 7, they reflect the allocation that you're actually going to list on the federal form in which you would have to file in the year of the sale. As you can see from the buyer's perspective and also the seller's perspective, it could be more or less beneficial for either party to structure the sale of the assets in various ways. Fixed assets purchase can vary greatly in terms of expense realization. You see it hits by varies. There's a lot of different methods, and the Internal Revenue Code Section 179 allows for up to 100% expensing in the first year of putting these assets in business if the asset qualifies. And I think the IRS lets that limit up to $1 million a year, so it's a pretty generous tax break. Does anybody have any questions on this chart particularly? We'll go right through it. I can come back to it. Here's where things can start to get exciting. So you and the buyer have come to an agreement on price and terms. Now where does the money come from? Buyer's down payment or cash funds? Bank, SBA financing? Did you know you could become the bank and take on the financing risk and be compensated for it? If you decided to hold the note for the buyer, you can charge interest on the amount financed. Also, holding the note allows you to qualify for recognizing the gain on the sale of your business under the installment method. This method allows you to spread the gain over the next 5 to 7 years, or however long you're financing it, if you have a greater appetite for risk. If you do decide to finance the sale, we would recommend staying by some of these terms at the beginning. We'd like to see the buyer put down at least 25% of the purchase price. Why? Because A, you will get some upfront cash to be able to enjoy what you've worked so hard for in your life, and B, you want to have the buyer have some skin in the game. Terms we typically see are in 5 to 7 years, as well as cases in the 15-year range. The buyer should be able to successfully generate enough income in that period to be able to pay off the business within that time period. When you're looking at rates can vary upon risk. We put 6 to 10. It could go higher, depending on the risk of the person financing. In this example I set out, you see a $250,000 loan at 7.5% interest, financed over 7 years, would net you just over $72,000 in interest income. It's a pretty considerable amount of money. Also, when you look at it in terms of cash flow, you'd be netting just under $4,000 a month, which would be a great retirement in addition to traditional retirements and Social Security. Also, if you don't have the cash flow needs at the current time, you can take that $4,000 of cash flow and invest it and have it earn income or appreciate in value. The most beneficial part of the seller financing is the ability to recognize the gain for the sale of your business over the time in which you finance the buyer. At a sale price of $350,000, the buyer put down $100,000 and financed with you the $250,000. We threw in there, just for making numbers easy, $175,000 is your adjusted cost basis after depreciation and recapture. What that left you with is a 50% gross profit percentage. When you, in the year of sale, you're figuring out this gross profit percentage, because that gross profit percentage will be applied each year in the principal payments you receive in that year from the buyer. So for this illustration purposes, we have $100,000 down. So in the first year, $128,000 in principal payments. Of that $128,000 you receive, you're only going to pay taxes based on the lower capital gain rates of $64,000. So depending on where your gross profit percentage comes in, it could be very valuable. So to sum up the financing, I think if you can stomach the risk, there's definitely plenty of value in financing the transaction for yourself. Sorry, I'm blazing through these too fast. I was supposed to talk slow.
More time for questions.
You've got time.
The final section of tax considerations that I want to talk to you guys about is the state and gift tax implications. I'll touch on 3 key points. First, the death of a business owner and what happens if you die owning a business. Then I'll talk a little bit about succession planning involving family limited partnerships and the gifting of a business to a family member. In our untimely death, what are we leaving our heirs? A mess or a turnkey business? Do you have a will laying out the terms of your last wishes? And are you willing to follow the state's probate laws by default? On a side note, if you're here today and you do not have a will, I highly suggest you leave here and contact an attorney. Let's take a look at what would happen even in the death of a business owner in the following business structures. So under a sole proprietorship, the business and owner are essentially the same person. You die, your business dies with you. If the state would liquidate all the assets of the business and distribute it in accordance with your will. If you didn't have one, it would be with the state probate laws in the state in which you live. C corporation still live when the owner dies. When you created that corporation or S corporation, you essentially created a whole new entity and a whole other person for tax purposes. Similar to the liquidation of a sole proprietorship, you would see your business would be liquidated and distributed based upon the terms of your will or the state law. LLCs are a little bit different. They're organized under the terms of an operating agreement. If your operating agreement does not say what exactly should happen, you can also amend that before anything does happen. But if it doesn't, and the agreement is silent, state laws will decide what happens when the owner dies and how the default dissolution and distribution of assets. Partnerships, LPs and LLPs, unless explicitly stated in that agreement, death would result in termination of that partnership. If you wish to bring your business and bring your family into your business and run a family business, then God bless you. It's tough. From both sides, the young and the old.
Oh, yeah.
The clash of generations can prove very difficult to operate a family business. There's a special type of partnership that we created called a family limited partnership. A family limited partnership is a partnership controlled by members of the family. When it's created, there's two types of partners, a general partner and a limited partner. General partners control all management and investment decisions and bear 100% of the liability. Limited partners can't participate in the decisions and have limited liability, but they can share in the profits. The partnership itself is not taxable. Instead, the owners of the partnership report the income directly on their own individual tax return in proportion to the interest in which they own that family partnership. In a family limited partnership, generally the senior family members, parents, grandparents, contribute assets in exchange for a small general partner interest and a large limited partner interest. Why? Because they can still retain control of the business that they're in turn going to be handing over to a family member. And these units can be sold too. It doesn't have to be gifted. Gifting can happen, or they also can be sold. Once the family partnership has failed, only kidding. There's been a time where you may want to give your shares of your business away to someone. The Internal Revenue Service has allowed for some very valuable annual and lifetime exclusions from gift taxes, which, with a proper plan and given over time, can allow you to seed your business to your next generation. Some of the limits on here vary a bit different because in New York State we have our own estate limit, which is $5.75-ish million. So if you're under that, you're fine. You can give your business away without paying taxes. But it takes into account your whole estate, your personal and your business assets. So, I mean, as a firm, we currently serve clients of multiple generations. We've had clients from 3rd, 4th, and 5th generations pass down their business to their family. We're here to assist you in anything you might need, possibly deciding to transition your business, whether it be a sale or a gift. Thank you for having me. If anybody has any questions, I'd be glad to.
So if it's the lifetime exclusion, you can give to the family to up to the limit with no tax on
Correct.
estate and the business?
It's your personal exemption. It's under you yourself.
It's a personal. So if your estate and a business is under, for example, LLC, so before selling, it's better to transfer to your name, like a liquidated LLC.
Well, you could gift the shares of the LLC to someone.
So
Those shares would have to be, I mean, if it's not a publicly traded business or didn't have a readily available market value, you would need a business valuation to determine what the value of each unit or share that you sold was.
And not the
Okay.
SBDC one. That won't
I'm sorry?
hold up. Not the SBDC valuation. That won't hold up in
Yeah,
court.
I know, but it's
someone that has ABV or someone that has very many years experience in doing business valuations.
Oh, thank you.
Could you explain your phrase clawback depreciation?
So clawback, it's just the name I came up with, but they call it recapture. Clawback has some more action to it, I think. So you buy an asset for $100,000. This asset had a depreciable life of 5 years. Over that 5 years, you received, when you filed your tax return, hopefully you received a depreciation expense. You received a portion of that asset's value over the years in which you figured that asset would be valuable for. So after 5 years, you've received the tax benefit of taking the depreciation on all of it. So when you're at this point now, your basis is zero. You have zero book value in the asset, and when you sell it, the IRS is going to add back up your depreciation that you took and count it as gain, a separate type of gain. That's all, and that's only on fixed assets.
Okay, so you sold the building, it's fully depreciated, you pay the tax on the total sale. Is that,
Essentially, yes.
is that a simple?
Essentially,
Okay,
yes.
all right, so if I'm thinking correctly
Yep.
when I say that, okay, very good.
So that would not apply for, say, vehicles.
No, it would, and any asset you sold. Yep.
Okay.
Any asset you sold,
I thought you said.
they call it built-in gain. You've already taken depreciation, and when you sell it, they're going to want to claw back some of that depreciation.
Does that work as well with the 179 expense?
Yes. Yep. The Section 179 is just a way for them to allow you to not wait for the 5-year period, to take it all in year one.
Is there a way around that clawback?
So
you give
can
it
minimize the effect of the clawback by allocating more to
Goodwill?
intangibles. Yes, goodwill, intangibles, covenants not to compete, anything like that. Goodwill may not be as attractive to the buyer, because the buyer, with typical goodwill, it's a 15-year realization period for the expenses, whereas a fixed asset may be a shorter period. So you get all the intangible stuff, money you can get from the buyer, and allocate as much as they're willing to allow you to. Because sometimes the bank will, if they're looking for bank financing, the bank is going to say a certain percentage which they'll allow to finance for goodwill or intangible assets.
Would a customer list be considered intangible?
Yeah, absolutely, yes. Customer list is a very valuable intangible asset. Any other questions?
And I think it's important to understand that tax benefits for a seller versus tax benefits for a buyer are often at odds, right?
Yeah, absolutely.
So goodwill is great for you as a seller, not good for me if I'm buying the business. Stock sale is really good for you if you're selling the business, not really good for me if I'm buying the business because I can't depreciate and I'm taking on your risk. So potentially as a buyer, I want to start my own business and just buy your assets. So that's the challenge of buying and selling a business in that negotiation piece, and especially understanding the tax implications, is that what's good for you is not necessarily what's good for the buyer. So it's important to educate yourself maybe what a buyer is going to be looking for, so when you negotiate, you can find maybe a good compromise.
100%.
Thank you.
No questions for me? I'll hand back if anybody wants to talk.
We got a minute. Anybody have any questions for Angela?
Nope. They see me enough.
Do you, I guess these PowerPoints are available, or do you have any?
So the presentation is recorded. I can certainly, I guess, share it. Doesn't bother
If
me.
you're okay with that, I'll send it to everyone.
Oh, great.
But I do recommend, if you haven't attended Peter Papas's Valuation and Preparing to Sell a Business, he really gets into some of the nitty-gritty of, the process. So go and look at the one that's recorded online. We were extremely lucky that he took time to fly all the way to the North Country from Arizona a few months ago to do that with us. So.
And I'll email that out in the follow-up email to this for everybody's there. Yeah. Perfect. Great. So again, I'm Danny Delaney with the Center for Businesses in Transition. I'm going to go through this part of the presentation pretty quickly because this is typically the kind of thing I would be doing for a more entrepreneurial audience, so from the other side of things. But to give you an idea, if you're looking to sell your business, looking to transition your business, and you want the Center for Businesses in Transition to start talking about your business out in the world, and showcase, what kinds of wonderful businesses or opportunities are available throughout the North Country, then I just want to give you sort of a quick overview of some of the ones that we're working with right now, and give you kind of a little bit of an idea of what that kind of looks like. And I always like to start by focusing on Manat Woodworks. This is outside of Potsdam. This is Gerard Manat. He is really not selling his business. He is looking for a journeyman to take it over. He's been doing this for a very long time, more than half of his life, and is trained as a master in restoring antique furniture. He makes the stains himself. He does the wicking. He does all of these amazing things with his hands and has been doing this for a really long time. This little shop that he has no electricity. He wants someone to learn from him over the course of 10 years. He doesn't have any kids. He's not really selling it per se, but he doesn't want those skills and all of the things that he's learned and been able to support his community with to go and just to the wind. He wants to be able to share that with someone. And so if sort of, some of the things about capital gains tax don't apply to you, that's okay. Still call us, still talk to us. You'll see as we go through some of these businesses, that a number of them are not necessarily, $300,000, $1 million businesses. Some of them are much smaller, or some of them have very different models. But some are publicly for sale, such as Moon Tree Designs, right on Main Street in Lake Placid. It's a very profitable, and when I say profitable, I like to take a minute to say, we don't go through the business valuations, we don't do due diligence on people's stories. You need to do that with the SBDC. You need to make sure that, that what you're saying to us is correct, but also, we just we're really storytelling about the businesses in the area. So, Denise has been in this shop for, I think, 27 years, and it's really an art gallery more than a gift shop. It's a beautiful place where generations of people come to shop, and she doesn't own the building, but she's selling the business itself. So that's an example that you don't have to own your business in order to sell it, and we're still interested in talking to you and trying to find someone to take over. This is Judy. She's at Garnet Studio. This is in North River. This is a little shop that's attached to her house. So she wants somebody else to take her business, where she has been turning Adirondack garnets and making this amazing handcrafted jewelry, into a downtown. So she's looking for us to help her find somebody to take this business over, but she doesn't want it to stay in the same location. So that's kind of a unique situation. Adirondack soy candles, I think this is a great example. It's a home-based business. She's doing craft shows. She's trying to sell it for, I think it's $10,000. It's not, it's not a huge thing. Certainly she doesn't have to worry about capital gains tax. But she moved out of the area and is looking for somebody to take it over. Has a good name recognition. She has a lot of inventory and supplies.
I always think that'd be a great business if you have kids that are curious, have the entrepreneurial bug, something to do
As long as
together.
they don't stick their hands in the hot wax, I think they'll be fine.
Older kids.
Lake Placid, somebody in here could tell us a little bit more about that. Yeah. Our friend from Lake Placid is here right now. This is a really great opportunity for somebody to take over a turnkey business, something that's operating, doing really well, has clients lined up, and that Lake Placid Pub and Brewery are still going to look to do the baked goods into the restaurants, the baked goods to go over into the restaurants. So you already have some contracts lined up, but you just don't really want to do wedding cakes anymore, right? You need somebody else who loves that, right?
Busy enough without the bakery.
So we need to find somebody who really has that love and passion and can take this over. So this
Make
is
me an offer.
Stevenson Lumber and Speculator. Also, we have some folks who could speak more to that here today. And I have to get some better pictures. These are some new ones. But this is great. It's a local hardware store and lumber yard, and has just a really great community presence, and they're looking for somebody to be able to sort of bring that. They have contracts with local contractors and construction folks, but that's a part of their business that could be expanded. Do you want to add anything to that, or?
Well, okay, yeah, I'm Larry Stevenson, and here's the challenge we have, and just listening today, I don't mind sharing this at all. It is a turnkey operation that, to be honest with everybody in this room, I'm willing to bet the price of it is more than what my financials will show for the last 3 years. And it was mentioned here, don't finance inventory. Well, there's $250,000 worth of inventory at that location. So here's my comment. It's I'm a financial person, and I just love running financials. That business is about, to run it turnkey, somebody would need to invest about $750,000. $250,000 of that is inventory. What I'm saying with that is that somebody would need to come in there. I think there's a fair amount of either family or cash or something to make that work. So in the end, it's not going to surprise me in the end of this whole process for us. It could be just land and governance. Who knows? Okay? So there's my only comment to the group as I learned what's here today and kind of what it's like.
No, that's great to share. Thank you so much for that. I'm sure all of you know someone in your life who has always wanted to own a B&B in the North Country, or the Adirondacks, or somewhere else, or a small motel. It's a lot of folks' pipe dream that's on the back burner. I'm not going to go through all of the accommodation options that we are working with right now, but I will say this is an area where we are actively trying to seek entrepreneurs' interest in that particular industry. So in June, we're going to be doing a teaser webinar, Is Owning a B&B or Small Motel Right for You? And highlighting a number of the accommodation options throughout the North Country that are available. So if somebody's interested in that, really gauging whether or not they are, giving them the sort of quick and dirty, like here are the things that, do you actually like people? Do you actually want them coming into your home, you know?
Do you like washing toilets?
Yeah. Actually, Nicole and I were talking about that yesterday. Having a lot of renters was a lot of washing toilets that maybe she wasn't expecting. And so really getting people through that process before they're coming to your door and saying, oh, I want to take this over. And then, like I was talking about earlier, talking about businesses in a way that can be a little more anonymous if you are not ready to really put it out there. So when I'm talking to entrepreneurs out in the world, I can say things like, in the North Country, there's also an outdoor recreation and guide business, a hardware and lumber store, a sports memorabilia and toy store, a commercial cleaning company, a franchise appliance store, a geothermal installation business. That's pretty specific, but they're actually a little more public about it. A furniture store, an optometrist office, a unique agritourism business, and a fly shop, and many more. So one of the other things that I just want to touch upon before I finish up here is there are a lot more opportunities for you if you have employees, which sometimes in the North Country, or oftentimes in the North Country businesses you may not have, but there are a lot of opportunities for worker cooperatives and to convert to worker ownership. This is kind of, for a lot of folks, it might be a new sort of burgeoning thing that folks don't know a lot about, or for some folks they're really well versed, but there might be some hurdles that you're concerned with. But there's previously, if your employees came to you and they wanted to buy the business altogether, it was harder for you to get financing as a cooperative because a lot of traditional lenders maybe weren't well versed in that, or there weren't as many resources for them to go to be able to help finance that transaction. Or there weren't a lot of resources for folks, for your lawyer or accountant or somebody else to really understand what a worker cooperative was and to go into that. So there's a number of things that we are doing and working with partners throughout the region to let folks know that this is an option, that if you think some of your workers or employees, they don't have a ton of money, they really don't need a lot of capital to purchase the business sometimes if there's a couple of them and they have a lot of passion. And so there's more opportunities for that. And there's a lot of learning that we're going to be working on. In fact, the June event coming up is going to be focused on worker ownership. That's going to be at the Adirondack Experience Museum. But again, it'll also be available online if you want to check that out. Or if you have interest in that particularly, let me know and I can connect you with some of our area partners, such as the Cooperative Development Institute, the Democracy at Work Institute, and the Cooperative Funding folks in New England. So finally here, I just have a little bit of information that got cut off, but about us, which is all in your packet, but transitions@adirondack.org is our email address. But really, you can also reach out to Russ Kingan. He's the liaison for this area, and he's out there talking about the program and really able to answer a lot of your questions to get started. And then, of course, and we cannot thank them enough, our partners with the SBDC, who are really providing the nitty and gritty technical stuff that you need to make this happen in order to have a successful transition. So before we get finished up, I will hand it back over to Russ, and then we will let you go on with your day.
So just to wrap up, I want to thank Danny again and Angela and Forrest for bringing these resources to our area. I was just asking Danny, if we weren't doing this, who would be? So it's a real privilege that between CBIT, SBDC, and the IDA, we're able to offer this to you guys for free. This is great advice that you're able to get locally, which is a great privilege for what we're doing. And I also want to acknowledge, the Franklin County Industrial Development Agency is not really a great name for the Franklin County economic environment. We're not doing a lot of big industrial development here, but we're really interested in small business. We're really interested in the kinds of businesses that we have in the area and what we can do to support you. So the local development corporation is a little bit more tuned into some of those resources, and we're trying to develop to help people just like you. So if you need financing, if that's an issue, We have lots of resources beyond banks to help you get the money that you need. So don't feel like that's something you won't be able to find. Come talk to us. We have all kinds of options, and we're always trying to develop more that makes sense. And last, we're developing this broad network of contacts around the region. Angela has a really broad network of contacts. So please, whatever your need is, come talk to us. It's confidential. You can trust us. We're not running our mouths about your business and your plans. We're here for you. So please reach out to us. And thank you again for coming. We really appreciate your support for this effort as well.
And let us know what else you'd like to see via the evaluation sheets, please, because we're planning our fall workshops now. So let us know.
All right. Thanks again.
Thank you.